Welcome back to Future Finance Lab. Today's episode is different. I just lost around $60,000 in a single day, and I want to show you exactly what happened in the market. Why it wasn't normal volatility and what it means for investors like us. This wasn't just a red day, it was fear. It was uncertainty. And for many investors, it was one of the most painful sessions they've experienced in years. Software companies collapsed. Names like Salesforce, Adobe, and Snowflake sold off hard. Data giants fell sharply. Even companies once believed to be untouchable were suddenly questioned. And behind a lot of this, there was one name, Anthropic. This was not just a bad trading day. It was a moment when the market started to rethink. Something much bigger, the future of entire business models in an AI-driven world. For years, investors paid premium prices for software companies because of predictable revenue, high margins, and strong customer retention. Software businesses were considered sticky. Once customers adopted them, switching became difficult. That stability justified higher valuations. Until now, most AI companies focus on consumers' chatbots, mobile apps, search tools. Anthropic chose a different strategy. Instead of targeting individuals, it went straight after enterprises. Recently, Anthropic introduced advanced AI tools capable of handling complex professional tasks. Not simple automation, but real financial analysis, legal research, and compliance work tasks that once required teams of highly paid professionals. Suddenly, those tasks could be done faster and cheaper. That changed everything. The market doesn't wait for proof. It reacts to possibility. If AI can perform high-value analytical work, then companies built around selling that work become vulnerable. That fear hit fast. Data providers, analytics platforms, and subscription-based enterprise software, especially names like Salesforce, Adobe, and Snowflake, were aggressively sold. Not because their earnings suddenly collapsed, but because their future cash flows became uncertain. This sell-off wasn't theoretical for me. In one day, my portfolio dropped by around 5%. That's roughly $60,000 gone in a single session. Losses like that are painful. But they're also revealing. They force investors to separate emotion from logic. Here's a mistake many investors make during sell-offs. They assume cheaper stocks automatically mean better opportunities. But price alone is not the answer. There is a difference between temporary fear and permanent business damage. Patience is powerful, but patience only works if the business survives. If the business model is being eroded, patience becomes denial. Time is a multiplier. If a company has a strong growing business model, time works in your favor. If the business model is decaying, time works against you. History proves this. Industries that failed to adapt stayed cheap. They weren't undervalued, they were just weak. Investors who waited didn't get rewarded. They got stuck. So how am I thinking about AI risk? AI doesn't destroy everything. But it does attack certain types of businesses very aggressively. Especially businesses built on information processing, manual analysis, seat-based pricing, and expensive middle layers. These models face real pressure. So I'm focusing my capital on businesses with structural protection. Some businesses are very hard to replace. Physical infrastructure, global payment networks, hardware-intensive manufacturing, massive consumer platforms. AI can help these companies, but it can't easily replace them. These are the types of businesses that still deserve long-term capital. In uncertain environments, capital should move toward clarity, not hype, not fear, but durability. I'd rather own a strong business at a fair price than a weak business at a cheap one. Valuation matters, but survival matters more. Earnings season during fear is brutal. Even solid companies get punished. That doesn't automatically mean they're broken. It often just means sentiment is fragile. Markets don't move on logic alone, they move on emotion first, and fundamentals later. This wasn't just a correction, it was a stress test. AI is forcing investors to re-examine their assumptions. Old moats are being questioned, new risks are emerging, and the market is adjusting fast. Losses hurt, but they also bring clarity. They remind us that investing is not about comfort, it's about understanding change. At Future Finance Lab, we focus on strong business models, long-term durability, and disciplined thinking. Markets evolve. Technology accelerates. But sound investing principles never change. Are you buying this dip, or are you selling in fear? Let me know in the comments. Thanks for watching, and I'll see you in the next episode.